We'll be talking about managerial economics and business strategy in today's video. The agenda is very simple. We'll introduce managerial economics and the strategy thereof, and what effects that is have on management, the economics effect. We need to identify the goals, the constraints, the scarcity, recognize the role of profit, five forces model, understand incentives, understand market, recognize the time value of money, and use marginal analysis thereby. So, yes, we are talking about managerial economics. A manager is a person who directly, basically controls resources. Why? Because he or she wants to achieve a one goal, certain goals. Economics is science of making the decision to make in presence of the rare circumstances, rare resources. I should use the words called scarce resources. Managerial economics is study how this direct scarce resources in a way most effectively can be utilized to achieve the desired goal thereby. So identify goals and constraints. Sound decision making makes involve having a well-defined goal leads to making the right decision. Striking to achieve a goal, we often face constraint that are artifacts of scarcity. Absolutely, yes. You have dilemma, you have a situation where you want to make the most of the best available options. So economic versus accounting profit. Accounting profit, total revenue, sales minus dollars, cost of producing. So it's sales minus the cost is what my profit is all about it. Reported on the firm's income statement. Economic profit, revenue minus the total opportunity cost. Accounting cost, the explicit cost of the resources needed to produce the goods or services. Reported on the firm's income statement. An opportunity cost, the cost of the explicit and the implicit resources that are foregone when a particular decision has been made. Economic profit, total revenue minus the total opportunities. I repeat, total revenue minus the total opportunity cost. So we have an opportunity cost or accounting cost and then the economic profit thereby. So you need to understand each one of them individually. So profit as a signal, profit signal to resource holders, where resources are most highly valued by society. Resources will flow to the into the industry that are most highly valued by the society. Absolutely, everybody wants to go make much more profit. So if I invest certain amount of money in one of these areas, one of the businesses, which gives much more profit than if I would have invested the same amount of money in a different business altogether. So what are we looking into? It resources are going to flow in the direction of the profitability. Understanding firm's incentive. Incentive plays an important role within the firm. Incentive determines how resources are utilized, how hard individual works. Managers must understand the role of incentives that have been played in an organization. Constructing the proper incentive will enhance productivity, will enhance profitability thereby. We are talking about market interaction. We are talking about the consumer product producer rivalry. Everybody is in tandem. The producer wants much higher profit, thus much higher sales price. The consumer, on the other hand, wants much cheaper profit or cheaper rates. So much lesser willingly to sell pay price. Consumer attempts to locate low price while producers attempt to change on a high prices. Then we have a consumer rivalry. The scarcity of good reduces the negotiating power of the consumer as they compete for the scarce good. If the product is not available in the market, consumers are willing to pay a higher price to procure one. Then we have that producer rivalry. A scarcity among consumer causes producers to compete with one another. On the other hand, if the consumers are less, the producers are vying for the consumer's attention, they'll fight it out. And the role of the government is the disciplining the market process thereby. So what are we looking into it? We are talking about the time value of the money. Please rewatch or slowly watch to understand what we are talking. So we have the PV as in present value, and then there's something called FV, the future value. $10 in your hand vis-a-vis $100 in your hand after 3 years. Which is more expensive? Which is more pricier? Is it worth having $100 after 1,000 days? That's 3 years approximately. Or right now the present value of the $10 is what? So you need to calculate the future values of $100 and one plus the rate of interest that's been applicable. That's the rate of interest and the number of years, if I may say so, the periods. So if you divide 100 plus 1 plus the rate of interest applicable into three times, what is the value. If it comes more than $10, it is better to invest out in the process, right? Or if it is less than 10 values, please don't invest those $100. Please enjoy the $10 that you have in your pocket, perhaps. So, present value versus future value. The present value reflects the difference of the future value and the opportunity cost of waiting, OCW. Succinctly, present value is nothing but future value by minus the opportunity cost of waiting. I have just given you an example of $10 in your hand and $100 which you will be getting in your hand in another 1,000 days, approximately 3 years. So if I is zero, the rate of interest is zero. Note PV is equal to FE. So $10 today and $10 after 3 years. What will you do? I would obviously enjoy the $10 as of today. As I increases, the higher is the opportunity cost in waiting and lower the present value would be. So this is what we are trying to go around here. So if the interest rate is very high, opportunity cost would be higher, right? And then the lower the present value. Obviously, yes. So that is what we should be looking out here. Present values of the series, present values of the stream of future incomes or amount received at the end of each period. Say, let's say the present value of whatever the thing is. You have a future value of 100 rupee, $100 or 100 dirhams, as the case might be. So present value is we need to find it out. So you have $100 after 3 years, $200 after 5 years, $500 after 7 years, $700 after 10 years. Now, these are your future cash flow that comes around it. N and N. So what are we looking equivalently? It is the present value and summations of the future value by time. That can be taking in and around. This is very easy for you to understand the cash flow of the business, the profitability of business, the sustainability of the businesses, whether if you want to invest in a business or not. So net present value, suppose a manager can purchase a stream of future receipts. Stream of future receipt. Let's say in terms of an example, let's say insurance, by spending approximately a dollar, $0 as of today. The net present value of such decisions would be future value, which is coming at the end of 1 year, 2 year, 3 year, 4 years, and so on and so forth, minus your investment. Minus your investment. So decision rule is when if net present value is less than zero, reject the project. And if it is more than zero, you should always accept the project thereby. So the present value of perpetuity, an asset that perpetually generates a stream of cash flow at the end of each period is called perpetuity. The present value of the perpetuity of the cash flow paying the same amount, the cash flow is equal to cash flow after year one, cash flow after year two, always is the same at the end of the each value. What are we looking into it? We are just not putting n, we are just putting an n values all to it. Now this is the present value of perpetuity. So every year, in my previous example, it was $100 after 3 years, $200 after 5 years, $300 after 7 years, $500 after 10 years, and so on and so forth. But in this case, $100 after 1 year, $100 after 2 years, $100 after 3 years, $100 after 4 years, $100 after 5 years, into the number of years. So what are we looking into it? We are just doing nothing with the cash flow divided by the rate of interest that has been charged. For maximizing the profit, that is what we are looking. That is what the firm will be valuing. So the value of the firm equals to the present value of the current and the future profits. The present value of the firm would be mu, zero as of today, then mu 1 by one of the rates, and so on and so forth. In totality, the summation of the mu things. A common assumption among the economists is that the firm's goal is to maximize profit. This means that the present value of the current and the future profit is to maximize the value then and there. Marginal analysis or incremental analysis, control variable, example, output, price, product quality, advertising, R&D. Basic managerial questions: how much of a control variable should be used to maximize the net benefit altogether? This is very important. So net benefit is total benefit minus your cost. If there are, if it is more than it, it is in positive terms, go ahead with it. Profit is nothing but your revenue minus the cost that we are looking out here. So marginal benefit is the change in the total benefit arising from the change in the control variable Q. So marginal benefit is delta benefit by delta quantities. The slope calculus derivatives of the total benefit curve thereby. We are talking about marginal costing, the change in the total costing, as on incremental change, 1 unit of changes of the total control variables. What are we looking at? Delta costing by delta changes. Instead of 100 quantities, can we have 101 quantities? Can we have 102 quantities? What is it? What is the impact in the cost? Is it increasing by how much degree? For by how much increases? Is it the same proportion, or is it changing just a little, or not even changing? If there are no sizable change, increase from 101 to 100, from 100 to 101, probably no changes in the cost. From 100 to 102, again no changes in the cost. But from 100 to 105, there is a change in the cost. From 100 to 120, there is a slight change in the cost. So we need to understand this slope, the calculation derivatives of the total curve. The marginal principle, to maximize the net benefit, the marginal control variable should be increased up to a point where marginal benefit is equal to the marginal cost. Remember, if the benefit is more than cost, means the last unit of control variable increases benefit more than the increased cost. Yes. But if marginal benefit is less, means the last unit of the control variable increases cost from 100 to 120. When it comes, it catapults. The cost goes higher, much higher. So you need to understand that at best scenario, you can serve 105. If you are budgeting for 100 units, the cost is still manageable. Allow me to give the geometry of optimization, the total benefit and total cost, what we are looking into it. So we are trying to have a benefit cost analysis. If this is the slope that goes around it, wherein in the x-axis is the quantity. So quantity one, $1, quantity two, $2, quantity three, $3, and so on and so forth that comes around it. This is what your benefit would be looking. Now is the point which you need to understand. This is what the cost from quantity 3, this is what it, quantity 5, this is what it, quantity 7, we have a cross out here, quantity 8 probably here, but quantity 9 or 10, it increases steadily up to the mark. So benefit doesn't match. What are we looking at? This is a point that needs to be understood as the break-even point, right? So you have the quantities where you can break. This is the ideal point beyond which you will not be able to purchase, beyond which the cost can be at the minimum, base minimum level. This is where the cost can be minimum level, but out here is the quantity that increases. After this point, it start increasing. After this point, it is absolutely loss-making propositions to go for it. The geometry for optimization doesn't adds up in totality. So what are we looking out here? This is my slope for marginal costing, and this is the slope for the total marginal benefit that we come across with it. Remember, at this point, the cost can be managed. At this point we are looking for a benefit management, but this is a point beyond which you should not be producing. This is a point beyond which you are making much of a production cost and doesn't make enough profit around here. So this is my slope curve thereby. So net, allow me to give the net optimization benefit. Net optimization benefit is the 1 unit, 2 unit, 3 unit, you are not making much of a profit. 4 unit, 5 unit, business expense, but not much of a profit. But here comes the pinnacle where not only revenue is more, maximum profit is also there. So that is where from this unit you start making losses, or if I may say, your losses would not be the right term. You are not making enough of profits. In fact, your profit diminishes, your work increases, and your profit diminishes over a period of time. So this is a time of Q1. You are talking about the slope of marginal net benefit. So marginal net benefit is what we are looking. So in conclusion, make sure that you include every of your cost, every of your benefit when you make a decision. I'm talking about opportunities cost. When decisions span time, make sure that you're comparing your apples to apples and do not compare apples to oranges. That is the present value analysis. Optimal economic decisions are made on the marginal analysis. That is what we are doing about in marginal benefit. How much can we make the most of the moolah? With this, I come to an end of this video. Thank you for watching the video till the end.